Hey everyone, good morning, Kevin here. We just had our first negative 1% day in the stock market for the first time in almost 2 months. For the first time since March 27th, the stock market dropped 1.2% last Friday, and there are a ton of things that you need to watch out for this week. But if you watched my last Sunday video, I told you that I was starting a position in MRAM, and I expected this position to take a little bit longer than it did to actually play out. However, we were up 160% on this position within just a week, as the market cap went from $400 million to over $1 billion. So, I closed that position up 160% on MRAM. However, I am going to give you a blueprint here as to how to tackle the market going forward. This is everything that you need to watch out for this week and how to take advantage of it from a trading and investing perspective. We are coming up on a historically bearish time frame for equities. From May to October in midterm election years, the market tends to see a correction. The average drawback is minus 10 to 12%. However, I want you guys to recognize something very important here. There are no years in that specific historical downside dataset ending. In the number 6, 1980, 6, as well as 206. Those specific years were actually positive for the index. And obviously right now, we have a year ending in 6. That is a very small sample size, but historically May to October in midterm election years tend to be pretty bearish timeframes. Now, although we have a new Federal Reserve chair that is supposed to start soon, the central bank named Jerome Powell as chair pro tempore until the replacement is officially sworn in. There is no date for the new chair being sworn in, although I believe the confirmation by Congress went through. So the swearing-in date has not been set in stone yet, and Powell will remain basically the de facto Fed chair until we have that ceremony. But I shared with you that we also tend to see a pullback during the first few months of a new Fed chair, as the market tends to test the central bank leadership. There was also a high-profile summit between China and the United States last week. China said that it reached a tentative agreement with the United States on some tariff reductions and trade cooperation by committing to buy commercial airplanes. But they also said that even though the United States allowed them to buy the HT-100 advanced semiconductor chips from NVIDIA, they are not going to buy them because they do not need them. I do not know if that is just geopolitical grandstanding or what the actual underlying motivation is there. And speaking of NVIDIA, we do have NVIDIA earnings coming up on Wednesday after the closing bell. Now, I believe that they are going to beat earnings and they are going to beat revenue, and it will likely be a record quarter, but obviously everyone is going to be focusing on the future guidance. We also have the massive tech initial public offerings coming down the pipeline, but that is for later. Now, in terms of how to trade this environment, I told you guys about using the 9 and 21 exponential moving averages on the artificial intelligence build-out stocks. And I previously gave you a list of some artificial intelligence build-out stocks. However, I have a complete list for you of all of the individual stocks that I am tracking from an artificial intelligence build-out perspective. If you just look for the resources I provide, I will send you the breakdown absolutely free detailing the complete list of artificial intelligence build-out stocks. But as I said, you can trade these actively from the 9 and 21 exponential moving averages, and if you followed that methodology, look at what happened with companies like AOI, for instance, which is a key photonic stock, and you could see that from the 9 and 21 exponential moving average setup just last week, it went up 53%. Same thing for Light, which is Lumentum Holdings. If you followed that tip from the last video, Lumentum Holdings was up 21%, so on and so forth. Coherent, which is another major photonic stock, showed the exact same thing, jumping right off the 9 and 21 exponential moving average support line. And as I said, you want to take advantage of this micro-trend until the trend is no more. I do not care what the historical statistics say about midterm election years. A lot of these specific momentum stocks are not even in the SP 500 or the NASDAQ index. But as I said, I think that the current market cycle is focusing heavily on photonics and physical data centers. Look at Nebius, which also made another all-time high, bouncing perfectly off the 9 and 20 own exponential moving average. Now, if this trend breaks, then yes, you stop executing this play because the trend is your friend until the end. But when this trend breaks, then you will know that is the exact time to let your foot off the gas a little bit on this specific technical strategy. With the artificial intelligence build-out stocks, we might also be seeing an early rotation into software. Look at IGV, which is the tech software exchange, traded fund. It is up a quiet 25% since April 10th. And I did a whole fundamental write-up on ServiceNow as well, creating a whole thesis for long-term investment, looking at their free cash flows, looking at their cash from operations, looking at their EBITDA, and looking at their total revenue, these all look like textbook linear growth graphs. It almost looks too good to be true, but ServiceNow is a company that is growing by all of the important metrics that you want to see a company grow by at a very consistent pace. Shout out to advanced fundamental tools that let us track these corporate metrics cleanly. But could we be seeing a broader rotation into software as Microsoft also looks like it wants to break out? Although it did drop a little bit after hours on Friday when it was announced that its original founder had liquidated the remainder of his position. To me, that liquidation is a complete non-issue. That founder sold most of his stock a long time ago, and he actually missed the opportunity to become a trillionaire because of selling most of his equity very early before this massive pump to the mid-500s. So for me, that individual selling his last bit of shares is not something I care about. He already missed this entire historical pump on the stock and sold way too early, missing out on a chance to become a trillionaire. And if we do get a macro dip in the indexes, that is going to be an absolute gift. The SP 500 has been on a massive win streak, and historically 52 weeks after these streaks, the index has never been negative. Now, I am honest with you guys, and I will tell you straight up when I do not know something. Is the SP 500 going to see a deep correction right here? I do not think that we are going to get a standard major correction here just because we had one bad day. But I do think that the market will likely test the Federal Reserve, especially after the first meeting or two under any new structural shifts. So I do think that we will see a standard correction at some point. I just do not know that that correction starts right now just because we had a red candle last Friday. But if we do get a pullback, that is 100% a viable buying opportunity. I think that the artificial intelligence build-out is still fairly early in its macro cycle. I think that there is still more market euphoria to go. And I think that the market will likely see a full rotation into things like software before there is a major secular bear market or a major correction. Maybe in 27. I do not think that a final top happens without these laggard stocks also flying high. Now, crude oil is still hovering at above $101 a barrel. Obviously, the international shipping straits issue is not solved whatsoever. And this, to me, does not bode well for the market at all over the longer term. The market spending almost 2 months with crude oil hovering around $100 means an economic slowdown is almost guaranteed at some point because of these energy costs. And we already started seeing consumer price index metrics come in at levels that we have not seen since the peak pandemic era. The consumer price index came in at 3.8%, the highest level since May of 23. Core inflation also rose to 2.8%, which was above Wall Street expectations of 2.7%. And the worst macro numbers of all were found in the producer price index. The producer price index surged to 6%, well above the consensus expectations of 4.5%. We have not seen wholesale prices rising this fast since January of 23. Core producer prices came in at 5.2%, above expectations of 4.3%. So the longer that inflation sustains at these hot levels, obviously the Federal Reserve is not going to be able to cut interest rates. I do not think that this central bank is actively going to raise rates, but the statistical chances of a rate hike are higher than a rate cut for sure because of this underlying data. And I think that the structural chickens will come home to roost possibly in 27. So I do think that there is still more market euphoria left in the short term, and it is our job to try to take advantage of that operational opportunity. But I do think that it will end badly at some point in 27. So you are really going to have to play this market cycle tightly. You are going to have to know when to manage your risk, when to take profit, and when to put your foot on the gas. And if you want access to all of my long-term analysis, as well as my swing trades, such as our entry in MRAM as well as the data center stocks, make sure you look for my platforms. Get yourself the best fundamental analysis tools available because it will do wonders for your portfolio and your overall ability to pick high-quality stocks. And go ahead and secure that free breakdown detailing all of these momentum stocks in the artificial intelligence build-out. I look forward to seeing you guys in the next video. Stay safe out there, traders.